Thank you, everyone, for joining. I'd like to first say that we appreciate you joining us on short notice. We didn't finalize the time of this webinar until really this morning, and so we appreciate your attendance. We typically, on a webinar like this, will average about 30 to 40 people to listen. Looks like we have about 19 today, which, considering that we announced this yesterday, is pretty darn good. We anticipate a lot of interest and demand for the project, and have had a lot of conversations with many people on the call or on this webinar, and also people not on the webinar. So thank you guys for joining us on short notice. So tonight we're going to discuss phase 2 of our Lake Charles Assisted Living and Memory Care project. So I think the most important thing when you look at a project is dealing with who's on the team. So the first thing I like to do is have everybody that's on the team kind of let me know they're here. So I'm Lo Hornbuckle. I'm the owner and operator of Sage Oak Assisted Living and Memory Care. I know we have Victor on the call. And Victor, why don't you take a minute, tell us a little about yourself in a couple minutes if you can.
Sure. So I'm Victor Monash. I think many of you know me. I'm a developer and part of the development team. I'm Lowe's development partner on this project. In fact, we have 4 development projects in Lake Charles right now, of which this is one of them. And so just real thrilled to have a super strong team put together here.
Okay, I see that we've got Mr. Dave Zook from the Real Asset Investor on the call. He's also a team member. Dave, you want to give a little intro?
Yeah, I'm Dave Zook. Happy to be here on the call and happy to be on the team. I have been watching the residential assisted living space for a number of years, and I was busy doing my own thing, and through mutual friends, Lo and I met. I was down to see Lowe's outfit down in Dallas and toured some of his product. He runs a first-class operation down there, and just happy to be able to partner with him and add some value to the team.
Don't be modest, Dave. You brought a whole bus full of people to one of my 4,000 square foot assisted living facilities and overwhelmed our capacity, but it was a fun day and it was raining really hard. So it was a good day.
It was a good time.
Do we have Pam on the call?
Yep, Pam's here.
All right.
Hi, everyone. I'm Pam Abide with New Orleans Equity Partners, also a team member. Thrilled to be a part of the team. Was introduced to Lo through Victor, and my business partner Sharon and I have been our local Louisianians. Been following the Lake Charles market for some time now, 4 or 5 years. Discovered the boom that was happening there, and said it's in our backyard. We have to be a part of what's going on and what's going to be going on there from now and for decades, we predict. So very thrilled. We identified some property, and you'll get a little bit more familiar with that through the presentation, but identified some property that was in South Lake Charles in a more faster growing pace area, and we really feel like the location is perfect. It's surrounded by residential, and Lowe's concept with Sage Oak will fit perfectly there. Again, just thrilled to be a part of the team and glad that we can contribute. And I think we found a great location to put a very successful project on the ground. So thanks for having me.
Yeah, that you have. And is Sharon on the call?
No, she had another meeting to attend. So.
Okay, perfect. So so Pam will be the New Orleans Equity Partner representation of the meeting. Now, if you detected that unusual accent, that is a South Louisianan accent that Miss Pam has. So she's there on the ground. I happen to also be a native from Louisiana, but the other side of the state. So we'll kind of get into the presentation now that you've got a chance to talk to a couple members of the team, and we'll also share all the contact information from all the team as well. Okay, so many of you have seen the business plan. This is a little bit about my resume. You're probably wondering, yours has a picture, it has a lot more information. This guy must have a really big ego. That's true, but the reason for doing it this way is because, when looking at an assisted living deal, if I was going to look at it personally, I would want to know a lot about the operator. And so one of the things we've done with our team is we have in-house operations, meaning that the owners of the property will also be responsible for operations, which really allows us to have a measure of quality control that sometimes you don't see with third-party management systems. So a little bit of background about the other sponsors. Charlton Holmes and Sharon are not on the call, but you've got a little information about them. If you want to contact any of the sponsors, we've included a page with their phone number and email address. You might want to take a photo of this in case you want to save any contact information. We will send a recording of this webinar out, so you don't have to take a photo, but if you'd like to, you're welcome as well. So let's talk a little bit about the deal. The basic executive summary is that about 8 months ago, a group represented by many of the people on the call purchased around 12 acres of land that was going to be dedicated to becoming an assisted living facility as well as a medical office complex. This call is about phase 2 of the assisted living and memory care facility. One thing that's a bit unique about what we do is that we have a very unique style of assisted living and memory care. So even though this is an 80-bed facility, we are actually each individual house, because they're basically homes, have 16 beds each. So we actually have 5 16-bed houses that will total to 80 beds. And what that does is that creates some advantages for us in the marketplace, and we'll talk about that a little later. But I want to make sure everyone understands that we are taking the residential assisted living model that I'd operate in Dallas, and that has become a very popular option for seniors in the country. We're taking that and we're scaling that on commercial property, and it allows us to sort of have a best of both worlds situation where we have all the advantages of a big building, but we also have all the advantages of a small residential setting that we'll talk about a little later. The total project is about $12,400,000, and of that, $4,700,000 is going to be equity from our funding partners, and of course that leaves $7,700,000 in debt. It'll be structured as a construction loan, interest only for 2.5 years, which will convert to permanent. We'll talk about that a little later. And we will handle operations in-house, meaning that the team that you're talking to is going to be responsible for the success of the project. Now, one thing to be aware of, and we'll talk about this a little further, the business plan that all of you have seen had a small error that we've had corrected. So we'll be sending out a revised business plan to everybody that is on our list. The good news is that the profit and total return for the investors have increased. The error was not with the total payout. The error was with how we calculated the internal rate of return. So we'll talk about that. So the internal rate of return did decrease. However, the overall return for the investors increased. And the project is still an awesome opportunity. So we'll talk about that a little bit just to make sure everybody's clear about what did and didn't change, what did and did not change, excuse me. So let's talk a little bit about the industry, because I think it's important for people to understand kind of what's going on in the assisted living memory care space. So you got a couple slides that we took out that are in the business plan. So I definitely encourage you to review those. However, we did keep a few key slides in. So the first is this infographic, so to speak, kind of lets you know what the industry looks like. A lot of people that ask questions about this, they don't really understand much of the differences between all the various different types of care. This visual aid really does help with that. So if I were going to place a care home or a residential assisted living facility, it would actually be somewhere on the sort of nursing home, dementia, Alzheimer's care, assisted living spectrum on the far right. many times, a lot of our clients, they come from the dead center. They come from the assisted living side. And they are in these big assisted living buildings that have a lot of structural flaws. They don't have very good ratios of care. They aren't able to personalize the types of care because, frankly, when you've got one caregiver for every 12 residents, one caregiver for every 15 residents at night, for example, there's just not a lot they can do to provide the level of care that people want. They struggle with communication often. They also struggle with food quality. And so we really try to position ourselves to be unique in the marketplace by keeping the caregiver ratios between 1 to 4 to 1 to 6. That's kind of our sweet spot. So all of our properties, you're going to have a 1 to 4 or a 1 to 6 direct care to resident ratio during the day, and then no more, say 1 to 8, 1 to 10 at night. That's a good target for us, and it's usually anywhere from double to triple the average that you would see in a typical large building. So keep in mind, even though we have 80 beds, it's actually 5 16-bed homes, all independently licensed, all separately staffed, separate meals, the whole 9 yards. So a couple things to be aware of in terms of trends in the industry. The industry is trending small. So what's happened is that these big providers have realized that these 100-bed, 200-bed facilities that look and feel, I have a friend of mine that jokes, if you put a guard tower on a fence, most assisted livings look like a prison. And so what they've started to realize is that they've got to make these smaller environments. You've seen a trend toward home-like rather than institutional feel. That's a nice bonus for us because they can't really get to the level that we can because we are building homes. So this is not a home-like environment. This is a home. It just simply happens to be designed for 16 residents. So each house will be about 8,500 square feet, give or take. So it really looks like a single-story mansion from the front, so to speak. And inside, instead of being a family, you've got 16 seniors in various levels of need. The second thing the industry is doing is there's kind of a myth of market saturation. So when I have conversations with investors, right now, a lot of the national senior housing news has kind of a negative spin. And what I'll tell you is there's a couple of key things. Number one is that's probably true in a lot of primary markets. So Dallas is almost always listed as a city that's heavily saturated with assisted living. However, my operation in Dallas averages between 95 and 100% occupancy. We have about 40 beds in Dallas. And so that's your first clue that we have kind of a unique selling proposition. The second component is that it's not really being overbuilt in secondary and tertiary markets. So one of our business strategies is we like to look at secondary or tertiary markets where nobody in a boardroom in New York is saying, how do we build an assisted living facility in Lake Charles? How do we build an assisted living facility in Denton, for example? So that allows us basically to come in, serve a need in the community, but also not have to deal with some of the absorption problems that you're having in some of these primary markets. So 2 big keys there. And not to mention, we also do market feasibility studies that also kind of confirm the success, the likely success of the project. We also test the likelihood of our rents being viable in the community based on net worth, based on income, and based on the aging population. And the feasibility study for Lake Charles was fantastic results. The third thing, and this is really important for the Lake Charles market, is skilled nursing is really struggling. So I'll remind you of that infographic that we looked at earlier. Skilled nursing was all the way on the right, except for the only thing that was more heavy care than skilled nursing was hospice. So hospice is end-of-life care. Skilled nursing is basically someone with a complex medical condition. A lot of people get assisted living and skilled nursing confused. They often merge them together. The main takeaway here is that, in general, skilled nursing is losing occupancy, and it's losing occupancy to assisted living. The lines between the 2 product classes are starting to blur. And the reason why that matters is because in Lake Charles, a lot of assisted living providers will refer to skilled nursing at inappropriate times, in our opinion. Meaning that you have someone that's in a memory care wing, and now keep in mind, this is a wing designed to deal with someone with dementia. has, access control, all the things that you would need to keep someone secure. I had many providers when I was in the market tell me if someone starts to wander, meaning they start to become an exit risk, we'll refer them to skilled nursing because we can't handle them here. That's literally the reason why memory care was designed, is to handle a resident like that. Another example would be that people would be referred if they maybe were a little on the heavy side, had a little bit of leg weakness, and so you had technology like a Hoyer lift, for example. A Hoyer lift is just a piece of technology that would enable you to help someone transfer without risking the caregiver's back, putting the resident at risk. There's a lot of people that need a little extra assistance. And in this marketplace, a lot of those people get referred to skilled nursing. The reason why that matters, I'm not just bloviating about the industry. Imagine having a choice between being a home-like environment with a light, airy feel, with an open kitchen, small number of residents, good ratios, or being in a hospital-like setting. Most people, when given the opportunity, would choose the home-like setting versus a hospital-like setting. The other reason why that matters is skilled nursing is more expensive. So in Lake Charles, skilled nursing might be $6,000 a month, $7,000 a month if you're a private pay resident. So there's a lot of residents that are inappropriately placed in skilled nursing. So at some point, Lake Charles is going to catch up to the nation and is going to start sending a lot of their skilled nursing people to assisted living, and that's where we come in. So that's a little bit about the skilled nursing situation overall, and also in Lake Charles in general. Now, I think there's probably nobody better to talk about the market than Pam, Sharon, and Victor. And so at this time, I'm going to ask them to just tell us a little bit about the market of Lake Charles, and tell us a little bit about how they kind of selected the market, and so you can kind of understand why Lake Charles to us is such a diamond in the rough, or needle in the haystack, so to speak.
Perfect. Well, thank you, Lo. So Lake Charles is not exactly a household name. It doesn't have any major league, NFL teams or anything like that. And the reason it exists is because it really started out its history as a natural gas importation facility. There is a network of natural gas pipelines emanating from Lake Charles, fanning out all over the country. And it really started out, as I said, as an import facility. With the tremendous growth of natural gas production, domestic production, coupled with the change of rules under President Obama, which now allows American companies to export petrochemical products, where before that was banned by Richard Nixon. That is now possible. So Lake Charles is now an export facility, and it really exists because of that major network of natural gas pipelines. So that's why we're starting to see liquefied natural gas plants, gas to diesel plants, petrochemical plants like ethane crackers. And in total, these represent about $118 billion of infrastructure projects over the next decade, of which $48 billion are currently under construction.
That's billion with a B, with a large B, yes.
Yeah, I mean, the scale is really staggering. You talk about a town of 200,000 people where at shift change at 5 in the afternoon and first thing in the morning, you can expect an hour to an hour and a half traffic jam twice a day, every day. And this town is absolutely busting at the seams, and they need everything. They've built a dozen hotels in the last 2 years. And, some of these hotels, when I go to Lake Charles, I spend more on a hotel stay in Lake Charles than I do in Houston. And they built a dozen new hotels. It's crazy. They built a 1,100 room Golden Nugget Hotel and Casino. Last time I went there, I couldn't get in. It was full. Pam got in because she's a high roller there, and so she gets to stay there for free. But for us paying folks, I couldn't even get in. So it's quite an interesting market situation. And like I said, they need everything, which is why we're heavily invested in this market with 4 different projects, of which the assisted living is just one. And there's more projects being announced every day, and it's not all about petrochemicals. For example, Citadel just recently announced an aircraft completion center. Now, what that is this is the outfit that basically does the interior of the aircraft. So the interior liner, the seats, the carpeting, the lavatory, the overhead bins, the coffee maker, all of that gets done at a completion center. So this will have several hundred employees of direct employment at an average wage of about $80,000 a year, plus another 500 or so of pull-through employment. So every single one of these opportunities is adding significant growth to the market. It's not just about petrochemicals, although they are kind of the anchor tenant in the community. And it's a unique situation because a lot of other communities tend to repel heavy industry, and Lake Charles has embraced it. So, when you get major companies from around the world, whether it's Sasol from South Africa or British Gas, now Port of Royal Dutch Petroleum, coming into Lake Charles, they say, oh, we're in a community that actually embraces us. They're not sending us away and bogging us down with decades of environmental studies. This is a town that really understands, heavy industry and how to make it work. And a lot of this heavy industry is actually fairly clean. Natural gas processing is not a dirty. It's not dirty heavy industry. It's quite clean heavy industry. So that's a little bit on the market, why it exists and why we're excited about it, because it's an investment that will span economic cycles. A lot of the demand for this product is driven by the widening of the Panama Canal. So now it opens up natural gas to markets in Asia. And of course, the most recent trade deal between the U.S. and Europe, Europe is very interested in having an alternative source of supply for natural gas. Today, the vast majority of it comes via pipeline from Russia via the Ukraine, and they'd like, an alternate source of supply. And, they've committed to build 14 natural gas terminals on the continent, in addition to the ones that are there now. And, whenever that conversation comes up, Lake Charles is usually on the short list of ports that's talked about in that conversation. So that's a bit about the market. So back to you, Will.
And a couple things to be clear. One of the questions we get occasionally, and someone may ask this, is, well, we saw an energy boom in the Dakotas, and that didn't turn out very well. So one thing we want to make clear is there's energy plays like an oil play or something like that. But this is a energy infrastructure town. This is not a situation where if the price of natural gas fluctuates, that it's going to change much.
Right.
So the reason why the Dakotas had problems was because the price of oil collapsed. If the price of natural gas goes down, that actually makes exporting easier and more affordable for the places we're going to export it to. So this is not a town that's going to be tied a lot to energy fluctuations. This is more like, so when you think about these energy projects, it's more like an airport than it is an oil well. This is an infrastructure piece. So just like if you follow a place that has a big airport going in, large highways, things like that, that's the city telling you something. And what the community here is saying is that basically we're accepting infrastructure that costs billions and billions of dollars that is not affordable to move. So therefore, it's a long-term market. It's not a short-term energy play market. The second thing to understand is how this relates to senior housing. Is many of these permanent jobs that pay $80,000, $90,000 for these high skilled jobs. What happens is they relocate to Lake Charles, Louisiana, or surrounding city, and they say, mom or dad who's over maybe a couple states away where they came from or whatever, maybe even further than that. They say, well, mom's in assisted living. We're relocating to Lake Charles. We better move her close by. So what happens is, even though assisted living and jobs are not interconnected directly, if you're looking at an apartment deal, for example, you're looking at jobs a lot. In assisted living, we're looking at more of age and net worth. However, age follows jobs. So I want to make sure you understand that connection, because we do get asked occasionally about, why is the jobs situation in Lake Charles relevant to an assisted living project? The feasibility study indicated that there's a great need for what we're doing today, and the demand in the future actually gets better and better as time goes on. So that's just a little bit about that. Pam, is there anything that you'd like to add to the Lake Charles piece, or shall we move on? Don't feel compelled to do so. I just want to make sure you're not being left out.
Thank you, but only to reiterate the fact that it's a much more diversified market than most people think, or that's their initial reaction. So the point that Victor made with regard to the diversification across the board, and then the point you made about it's not a boom and bust town. There's so much more to that with the port, even the Port of Lake Charles, and the jobs and the industry that's creating, bringing those people into town. It directly reflects what you just said with regard to having parents, wanting parents nearby. So.
Absolutely. Okay, so that's a little bit about the Lake Charles market. There's more information about jobs, which we provide in the business plan. We'll also kind of get more into the investment opportunity. So the first thing to be aware of is that a little bit about the project overview. So phase one was the acquisition and guiding the land through the entitlement process. That's essentially been completed, although technically it's not completed until phase two begins, which we're having a conversation about now. We moved the project through the entitlement process. It was approved unanimously by the city of Lake Charles, probably both because the team did a good job of positioning the project as being something the community needed. And at the end of the day, anecdotally, when we talk to people in the community, we never hear anybody say this isn't needed. We always hear this is needed, this is needed, this is needed. That's the consistent theme when we talk to anybody that's in the community. One of the things we've also done is we've assembled a team. Now, obviously, the team that's on the call, those are the deal sponsors. But we also have an architectural team. We have a building team that are local to the region. And what that means is they know people in town. It makes the process simpler and easier from a construction perspective, from an architectural perspective. They know exactly what's typical of the local market. And so it allows us to really move through the process seamlessly. And I got to tell you, we didn't go with the cheapest architect. We didn't go with the cheapest builder. We went with the builder and the architect that we thought would be the best for the project. Because at the end of the day, when you're going to be charging $5,000 a bed, $6,000 a bed, you want the best product to put forward to be able to do that. So phase two, which we're talking about tonight, would consist of the construction of 6 buildings. 3 of those homes will be licensed for assisted living. 2 of those homes will be licensed for memory care or dementia care, and they'll have a standalone sales and administration building. The 5 homes are going to accommodate 80 residents total, and the sales and admin building is going to have key people like the on-site management team, which will be the executive director of the community, nursing staff, marketing, the activities director or director of resident engagement, and of course the maintenance team. Now we'll talk about this a little bit later, but there is an opportunity to do a phase 3. Our site will allow for up to 8 homes, which would be an additional 3 homes. And those additional 3 homes could represent as much as 48 additional beds. The phase 2 investors will have an exclusive option to invest in phase 3. So what that means is that we will not do a capital call if we think that phase 3 makes sense. We're not going to do a capital call and call the investors and say, hey, you got to pony up some money because we're going to do phase 3. We're going to give you the option. If the phase 2 investors want to invest in phase 3, we'll make a spot for everybody involved. Keep in mind that because phase 2 is much larger, you will not be able to keep the same dollar amount necessarily in phase 3, but we will give everybody the opportunity who's in phase 2 to invest in phase 3. If whoever doesn't participate will then do a similar capital raise for phase 3. And what will end up happening is, even as a phase 2 investor, if you don't invest in phase 3, which will be the 3 additional houses, you're still going to enjoy the benefits of shared management expenses. You're still going to enjoy the benefits of the fact that phase 2 owns the land. It's going to have to sell the land to phase 3, so there's going to be money coming in if that were to happen. So everybody in phase 2 is definitely rooting for phase 3, regardless of whether or not they invest or not at that time. So here's a little information about where Lake Charles is located. For those of you that are investing in the project and can't find it on a map, we've provided a map for you. The second piece is we also mentioned in the lower right-hand corner that we did complete a feasibility study. We found a top-notch research company, MDS Research, out of the Dallas area. I think in Fort Worth is where they're located. And you can see that the occupancy rates in Lake Charles are 95, 96% for assisted living and memory care. That's anywhere from 7 to 8 points over the national average. So it's a market that has very, very strong occupancy. And frankly, there's no product class like ours. So we're very excited to offer kind of our unique product to the market. I'll talk a little about the unique selling proposition because here's the reality. Part of what you want to know as an investor, I would assume, is why are we going to win? So if we get into a battle, so to speak, with another assisted living provider in the market, or if they start to build additional assisted living projects, how are we going to compete? And the answer is that we reduce the business down to 3 simple things: great care, great food, and great communication. The thing about it is that most of the big buildings haven't really figured this out yet. And so what they do is they have a gym that's a little nicer, a chandelier that's a little shinier, a little fancier. But other than that, they're all the same. And they don't like to have good staff ratios. So they'll have one caregiver for every 10 residents, one caregiver sometimes at night for every 20 residents, whereas we're going to be double and triple that in terms of direct care staff. Also, too, just imagine most people in the South, especially, never lived in an apartment. They spent 40 or 50 years in a home, a 3,000 square foot home perhaps, and as time went on, they might have only used 200 square feet of that house. So the lifestyle provided by our community is very familiar to them. They can remember a time when they were, hanging out with 12, 15 people. They probably never had a time where they routinely ate with 40 or 50 or 100 people. And so the type of care that we offer, the type of building that we offer, it really does resonate with these seniors, especially in the South, because it's not like New York. People grew up in homes. So the phase 2 investment opportunity, we'll spend just a little bit of time on this. And you can see in the lower left-hand corner that we've color-coded which houses are going to be in phase 2 and which houses are going to be in phase 3. Basically, for the $4.7 million in equity, funding partners are going to receive 2/3 or 67% of the long-term equity in the project. However, until they get their capital plus 25% back, we're actually going to distribute 80% of the cash flow. So they own 67% of the deal, but they actually get 80% of the cash flow until we hit the 125% of capital return metric. And it goes on to say basically that if we were to, the goal is at the end of year 4 to do a refinance that should allow us to hit that 125% metric. And in doing so, then the 80% would revert back to 67%. So that's the basic structure of the investment. So they get 67% of the deal, but they get 80% of the cash flow until we return 125% of their capital. So the next component, and I should say in the lower right-hand corner, it's blocked from my view, that the minimum investment is $100,000 and the maximum investment is $1.4 million. People wonder sometimes, hey, why do you have a maximum investment? Well, the reason is because we don't want you to be over 20% of the deal. Otherwise, then you have to, by bank rules, have to be a personal guarantor. So just keep that in mind. Minimum investment $100,000, maximum investment of $1.4. This has some key information about how the investment's structured. You can see the capital stack, which kind of speaks for itself. I do want to talk about the debt for a moment because I have a close friend that's involved in development of senior housing. And he called me about 5 minutes after the business plan came out and he goes, "You guys got a 7-year construction loan?" And I said, "Yes." He's like, "I've never heard of that in my entire life." And I said, "Well, we got it." And he's like, "Did you sign a commitment letter?" I said, "We did." So one of the things we negotiated was because we obviously want to refinance between years 4 and 5, the goal being at the end of year 4. But if there is some sort of fluctuation in interest rates or some challenge that we can't foresee, that extra couple years could really come in handy. So we negotiated a very favorable deal where 2.5 years of interest only, floating at Wall Street Journal Prime, and we have 4.5 years fixed 5.75% with a 25-year amortization, with pretty aggressive loan-to-value, loan-to-cost. In the right-hand corner, you can see the use of funds, kind of walks through the construction budget. We also have an operating loss reserve that will allow us to get to the lease-up period. You'll notice there's two things that have asterisks by them, a construction management fee and the developer fee. Those get paid to the sponsors to allow us the opportunity to manage the project and also to, do everything necessary to raise the funds. You've got your furniture and equipment, and below that, obviously, you have the total. So that kind of gives you a little overview about the investment structure. Just a quick conversation about the legal structure. We want you to understand that we're going to use the most advanced techniques to try to protect the investors and to protect the company from liability. A lot of people are concerned that senior housing is a high liability business. Believe it or not, it's actually not that high of a liability business. Mostly it's a misperception. But a couple things to be aware of. We have real estate held in one company. We have a company that interacts with the customers in a different company owned by the same parent company. What that allows us to do is allows us to cut down on the number of tax returns we have to do because only the parent company has to file. The funding partners on the left and the sponsors own the parent company collectively. And then lastly, the management company will be a company that I control, meaning I'll be responsible for, and my team will be responsible for, the licensure, the leasing, staff, HR management, things of that nature. So it really does reduce sponsor and investor liability. So this is the revised 10-year pro forma. So we'll be sending this out either this evening or in the morning. This is where a couple of changes happen. So initially, when we did the internal rate of return, in our infinite wisdom, we managed to do a 9-year projection and call it a 10-year projection. We didn't start at year 0. We started at year 1. Well, you can't do that. You've got to start at year 0. So the internal rate of return that we sent out last time was 17.08%. The internal rate of return has dropped to 16.47. I would like to point out, however, that the total profit for the investor actually increased with this new plan, and I'll tell you about why in a second. It was at 132%. Now the total profit for the funding partners is 138%. That is primarily because when we realized that we made a mistake, it was important to us to rectify that. And so we did a couple of things. The first thing we did was we reduced our asset management fee from 1% of revenue to 0.5% of revenue, meaning that we basically took the hit on the sponsor side to try to help make sure that the deal was as attractive as it was before. The second thing is the original business plan in year 2 had a $200,000 preferred distribution. This one has a $300,000 preferred distribution in years 1 and in years 2. So you can see that in the lower left-hand corner. That's the bulk of the changes that we made. We'll obviously send this out. You can kind of compare things side by side, and we'll be happy to answer questions about that. But the bottom line is that the overall profit is actually higher, and most of the mistake was eaten by the sponsors. The only thing that really changed was we added a year 0, and we also changed the preferred investor distribution in years 1 and 2. So we won't spend a lot of time on that now. We can take questions on that in a moment. This page right here, just to give you a little idea, kind of gives you an idea about what the project's going to look like when it's stabilized. You can see again in the lower left-hand corner that we reduced the asset management fee to 0.5%. It was originally at 1%. And you've got kind of a visualization of basically when we anticipate key metrics to be hit during the project. This has a financial overview. The main reason to look at this is want to realize that the construction budget's on the right. So that just kind of gives you an idea about our anticipated construction budget. We'll have a finalized construction budget in the coming weeks. We have built in some contingency in the deal so that if we miss anything or if you have any kind of changes in lumber prices or whatever the case may be, we feel like we can absorb those changes. We're also very familiar with the contractor who's doing the construction because they are the winning party on the apartments, which are the adjacent parcels. So we're pretty familiar with their bid process and kind of know what to expect from them. So we talked about this briefly, but I want to make sure this is clear to everybody. Everyone that invests in phase 2 is going to have an option to invest in phase 3. Again, it's an option, and this kind of lays out some of the key details. Basically, what's going to happen is if there is as much demand for phase 2 as we anticipate, and we're very successful in filling the beds in phase 2, then the natural question becomes, can we add additional houses? And the answer is yes. And at that time, we'll assess the market, determine if we need more memory care, if we need more luxury assisted living, if we need more basic assisted living. And the next 3 houses will take shape based on that. In order to keep things simple, phase 2 will sell the land. So the houses shaded in the phase 3 coloring will sell the land at a price of $1,150,000. A portion of that money is going to have to be paid to the lender to reduce the payoff, and the rest of that money will come into the deal and be split based on whatever the split rules are, whether it be 80% or 67%, depending upon when it happens in the deal. The only thing the sponsors are going to receive is there's a lot of mechanics involved in selling the property, things of that nature. The sponsors will take a 3% purchase price at $34,500 just to cover the stuff necessary to make that transfer. Then after that, it comes into the deal and gets paid out. Subsequently thereafter, if a phase 3 does happen, which would be very exciting, we don't need to hire an additional executive director. We don't need to hire necessarily an additional marketer. So what happens is all of the shared expenses get split. So for example, if we have a 15-passenger van that initially is being split by, say, 5 houses, now that 15-passenger van and the costs are going to be split by 8 houses. The salary for the executive director, the communal water bill, things of that nature. You know, if there's a pothole in the road that needs to be repaired, it's now being split over 8 houses instead of 5. What that means for phase 2 investors is you'll actually see a likely increase in the net operating income in phase 2, even if you don't invest in phase 3. So to be clear, you'll have an option to invest in phase 3, but if you choose not to do so, you will actually make additional money because there'll be additional NOI, there'll be additional cash flow for the phase 2 investors. So I hope that's kind of clear. We have already had a conversation with the lender to let them know what our plans are, and we will have in writing what they will release the land for phase 3 to us for. So once we have that information, we'll pass that along in the form of an email or put that in the operating agreement. So that's the gist of the phase 3 option. And basically, we've kind of come to the point now where we've kind of concluded the presentation, and I'm sure that you guys and girls are going to have some questions. So we can kind of open it up for question and answers now.
So if you want to input the questions in the chat window or say them out loud, you can unmute your microphone, or if you're on the phone and you're muted, you can press *6 to unmute.
Okay, we do have one chat box here. Dave says he's collecting questions, and we'll get to every one of them before we end the webinar. So Dave has told everyone that. So who has a question they'd like to ask?
All right, while they're gathering their questions low, I've had quite a few conversations with phase 1 investors today, and one of the questions that kept coming up was, and they're thinking, like every investor should be thinking, how long the cash flow? So could you address that and just bring that out? What an investor coming into the deal, how long does that time period go till we get some cash flow?
Sure. So I went ahead and pulled back up the additional slide. So we think that the project will begin to naturally cash flow sometime around between month 20 and month 24. However, because we are sensitive to the fact that, and David, you'll just mute yourself for the time being, there's a little bit of background noise. We're sensitive to the fact that investors have that question. Most of us on the team are investors as well. So what we've done is we've actually allocated $300,000 to be distributed at the end of year 1 and at the end of year 2 to basically allow for cash flow to happen earlier. So you can kind of see that at the end of year 1, at the end of year 2. And then, of course, you see a big uptick in investor distributions and the third, and basically in between months 25 and 36. And that's based on the fact that at this point, the asset is stabilized. We should be close to full at that time. And that basically allows us to distribute based on cash flow. So the first $600,000 is basically going to be preferred distributions. And then the next year will then be based on actual cash flow from the deal. Dave, does that get you answered up? You have to unmute yourself.
Yes, we're good. We're good. Thank you.
And maybe just to elaborate on that a little bit, we recognize that, investors that are investing in projects like this, cash flow is important. So we actually put in the budget an interest reserve for paying out that preferred return, just the same as you would have to have an interest reserve as part of your budget for your construction lender. You don't have cash flow yet from revenue, so you've got to have a reserve as part of your budget. This is no different. So it's a feature that we build into all of our cash flow projects.
Okay, so checking out the chat box. Let's see in order here.
I'll read them off to you there so you don't have to look. Kevin is asking if the project runs into headwinds after year 4, when it's refinanced, will investors be liable for unpaid debts?
Okay. Kevin, if you'll unmute yourself, I'm going to have you unpack that question just a little bit. So what liability concern do you have for unpaid debts? Walk me through that if you don't mind.
I'm checking if my microphone, oh, there we go.
Yeah, you sound great.
Okay, the question was, okay, it gets refinanced and we would be at 102.87% of the money would be back. So in theory, okay, all the money's returned. Is there any, but it would be refinanced to a higher, back up to about what, 80% of the project value?
Correct, that's correct.
So if we ran into headwinds after that refinance and after the investor got their money back, would the investor, say it went kerplunk the next year,
sure,
would the investor be liable? Who is co-signing that 80%? So where would that come from in a worst case scenario? Okay,
so yeah, that's a good question, Kevin. So if you want to unmute yourself for the time being, I'll answer and then I'll check back in with you. So essentially, right now, myself and one of the other sponsors, Charlton Holmes, are guaranteeing the debt during the construction phase. Unless you go to some sort of government-sponsored entity, there's no way to do a construction loan without doing some kind of personal guarantee. So we are personally guaranteeing the debt. Our anticipation is that the personal guarantee will go away after the refinance. The reason we think that is because obviously when you give a bank an income stream, it's a much easier deal for them to underwrite. So most of the lenders we've spoken to don't anticipate us having to be personal guarantors once that takes place. The investors are limited partners essentially. Their only liability would be is if we felt it was in the best interest of the project, theoretically you could have a capital call. However, that's not our goal. And we'd only do that if we felt that the situation called for it. So, for example, if there was some sort of $50,000 shortfall and we couldn't figure out a solution, we're not going to let a project fail over something like that. So the investors don't have any liability. Our operating agreements always state that if an investor does not want to be part of a capital call, they don't have to be. So if we say, hey, everyone in the project, we need to raise a little bit of money, and Kevin, picture if you'd mute whoever that is in the background.
Sure.
Kevin, if you were to say, hey, I don't want to be part of the capital call, then you would simply say opt out, and then your equity would just simply be diluted. So you would never have to put more money in the project than your initial investment. We also do maintain, pretty sizable cash reserves to ensure that that doesn't happen. And also the lenders are requiring myself and Charlton to maintain some personal liquidity as well. So I hope that answers your question. Does that answer your question, Kevin?
Yes, it does. Okay, you're maintaining some personal liquidity, or that's where some of it is, and you're hoping the company, after the refinance, the company in itself would be would be guaranteeing it, so to speak. There wouldn't be any more from you or the limited
If we have
partner.
to be personal guarantors again, then we will. Because obviously we're guaranteed, the riskiest phase to be personal guarantors is during construction. And so obviously I'd be comfortable being a personal guarantor, on the same project in subsequent months. However, to be clear, investors are not responsible for anything. The way the deal is structured is no liability will come back to the investors who are not actively managing the project.
Okay. Yes, that answers my questions. Thank you.
Perfect. So
All right.
go ahead, Dave.
All right, Lou, Mike is asking, in the initial offering memorandum that was sent out, year one cash on cash return was 0% and year two cash on cash return was 4.2%. Did I read correctly that the updated offering memorandum was 6% year one and two cash on cash return?
Hey, Mike, you actually did read that correctly. So what we decided to do was, whenever we had the internal rate of return math error, is that we had some funds on the sidelines that we decided to deploy in the deal. So we wanted to get as close as we could to the internal rate of return. And secondly, we also decreased the asset management fee collected by the sponsors. What that did was, not only did it increase the net operating income, but it also, when you increase the net operating income, you also increase the value of the project. So you did read that correctly. In some ways, in many ways actually, I think the updated business plan is better for the investor. If you are strictly investing off internal rate of return, then yes, the internal rate of return did go down by 0.7%. However, the total return went up, and the timing of when you start to receive cash flow or distributions was sped up. So that's the basic gist of the changes. Does that answer your question, Mike?
Yes, it does. Thank you, Lo.
Perfect.
All right, Lo, Doris is asking, what does the phase 3 investment look like, and how would the cash flow split? Would it be similar to phase 2?
Yeah. So good question, Doris, and I'll answer it to the best of my ability, and then we can unmute you to see if we get it answered. The phase 3 investment will look like this. We do not know the nature of the terms to be offered in phase 3. So to be clear, we do not know what we're going to be offering in phase 3. Part of the reason why that's the case is a couple of things. Number one, we could do 3 memory cares. We could do 3 luxury assisted living. Theoretically, we could do a skilled nursing facility in one of the houses. The point is, we don't know what the market's going to want at that time. And so the whole plan is if we've got a wait list of 10 people for our memory care and we've got a wait list of 1 person for our assisted living, well, we're going to take that information and we're going to respond to that. So the plan would be to do probably a feasibility study before phase 3 and determine what types of houses would make the most sense for the market. The second component is, trying to predict, the cost of construction, maybe 4 years from now. It's a little bit tricky. So the plan would be to send out a confidential private placement memorandum like we've done now to all the phase 2 investors, offering this investment to them. In order to guarantee everybody a spot, everybody would have the same, basically the same prorated amounts allowable. So for example, we have a $4.7 million raise. If you invested $100,000, you're 1/47th of that. So your guaranteed spot would be 1/47th of phase 3 if you want it to be. Now, of course, if anyone backs out, the phase 2 investors would have the opportunity to gobble up any of their unclaimed shares. And then after that, if the raise is complete, we move on. If the raise isn't complete, then we'd open it up to, lack of a better term, the general public, not necessarily the general public, but additional investors. What that would mean is phase 3 would function like a independent business. However, there's going to be shared expenses. So I'll give you an example that might make sense. We have an apartment complex that we're working to develop on the adjacent parcel. Both the apartment complex and the assisted living are going to be new builds. When you have new builds, you don't necessarily have as much need for a maintenance guy. So since we happen to have all the sponsors of the apartment complex here together, they're totally separate projects, but we're smart enough to figure out how to share a maintenance guy. We're going to do it because why pay for 2 maintenance guys when 1 maintenance guy will solve the problem? So that kind of gives you an example of how we kind of structure it. The thing to understand is that what that's going to do is that's going to lower the expenses for phase 2. So if you're a phase 2 investor and when we ask for the capital to do phase 3, if it's not available to you or you're not interested in the project, you can opt out and you'll make additional money because the net operating income of phase 2 should theoretically increase. You also make money because in order to give the land to phase 3, we're going to have to sell it. It needs to be an arm's length transaction. And so therefore, there'll be a predetermined sell amount, which is basically the amount of money the land is worth combined with the initial cost of roads, electrical stub out, plumbing, things of that nature. So the goal is we're going to have 3 pads sitting there waiting for when the market says, hey, you successfully done phase 2, get ready for phase 3. So if you want to unmute yourself, Doris, I hope that answers your question. If you have a subsequent question about that, please let me know.
Yes, that's fine.
Okay.
Thank you.
You're welcome.
All right, Mike is asking what interest rate are you assuming for the refinance?
I think we skipped over Andrew Zimmerman's question, but I think it was answered already. We have in the operating loss budget, Andrew, we've allocated money to be distributed. We didn't show that money to be distributed in the original offering memorandum, but we have opted to show it as being distributed in the subsequent offering memorandum to help improve the internal rate of return compared to what we turned out as before. So Mike's question that Dave just read out is, what interest rate are you assuming for the refinance? It's a good question, Mike. I had this conversation with another investor earlier today. We're using 5.5%. Our current finance terms are 5.75%. I think everybody on the call probably believes that interest rates are going to go up. However, I also think that everybody on the call probably thinks that we're probably going to enter a recession sometime in the next 5 years. So the nice thing about senior housing, it's a very recession-resistant business. If you look at healthcare or you look at assisted living, senior housing was the only commercial asset class of real estate to have an increase during 2009. So we actually had rent increases in 2009 during the depths of the recession. Senior housing is pretty recession-resistant. So a couple things, in our opinion, are going to happen. Number one, it's very difficult to try to figure out what's going to happen in 4 years or 5 years with interest rate. I think we all agree if we knew that, we'd all be geniuses. So what we try to do is we just kind of model for what's happening currently. Now, if we were going to do a refinance next year, then we'd probably model for maybe a 0.5 point or 0.75 point of higher interest rate. But the challenge is I think we all think that interest rates are probably going to creep higher, but we also think that there's going to be a recession, which is going to cause interest rates to come down. One of the reasons we negotiated a 7-year construction loan was if we get to year 4 and interest rates are, higher than we anticipate, but for whatever reason we think they're going to go down, we have the luxury of being able to delay that refinance until we can kind of get to an ideal period of time. So the basic gist for us is we've basically modeled for the refinance to happen at a rate environment that's very similar today. We didn't do that because we were lazy. We did that because it's just really difficult to kind of predict what's going to happen with interest rates 4 and 5 years from now. So, Mike, if you want to unmute yourself, I hope that answers your question.
Yes, it does. Thank you.
Perfect. And by the way, if anybody on the call can tell me what's going to happen at interest rates 4 to 5 years from now, please send us an email. We'll put you on the team, and we can just start. We can make a lot of money in the bond market if you know that very, very closely. Dave, I don't believe we have any questions. Anybody that didn't type one in, if you wanted to unmute yourself and ask it out loud one at a time, we'll be happy to do that.
We do have one more. Doris is asking, what other projects similar to this is in existence? Doris, are you asking what other project Lowe has?
I'm curious of what other projects that that may be in existence.
Sure.
That's not you, but in the market.
Yeah. So, so this has actually been, and thank you, Doris. This has been something that has been in my head ever since I got into residential assisted living. One of the challenges with residential assisted living is it's somewhat difficult to scale. So when you have 8 beds, when you have 10 beds, it's kind of tricky to hire a management team. So you got to have 4 10-bed facilities or 5 10-bed facilities to make the numbers work. There are, in Dallas alone, probably about 10 communities very similar to the ones we're developing. One thing I want to make clear is they have 3 major flaws that our model solves. So the first thing is, in order to save money, they usually build their roads in the center of the project. Now, I'll go back here to our site plan, and what I will tell you is we built our roads to be on the outside of the houses, where the houses, so you can see the site plan here. You can see here that you could save money on roads by putting the, where you see the green spaces between the house, you could put the parking there. And what that would do is it would mean the houses would face each other. And when you're standing in the parking lot, you'd feel more like that you were in a medical office complex or attorney's offices than you would a residential neighborhood. By turning the houses to face the street and spending a little bit more money on the roads, you get a much more nice environment. The second big advantage is when you look at the sales and admin building, I have not seen a community in assisted living like this that has a standalone sales and admin building. You might not think that matters a lot, but I'll tell you, we're willing to spend whatever it costs to build a 2,700 square foot building to do it, because the sales process, the consultation process in senior housing is very, very important. So imagine one of our competitors. Now, there's none of these in Lake Charles, but imagine someone that I mentioned before that has this model a little broken. A family wants to go on a tour, and they have to bounce from house to house to house to find the person that's going to give them the tour. Maybe their mom or dad has an assisted living need. They have to go into a memory care house. They're greeted by a couple of residents that have dementia. It really does make the experience a little bit different. So what we've done is we've allowed ourselves to have a sales and admin building, which will allow the consultation process to happen prior to consulting with someone about, what's right for them. You want to build trust, you want to build a relationship, and you want to slow the process down. The third thing, and this is very critical, if you notice the shapes of the houses are kind of weird, so we say unusual. These are actually the older designs, but you'll notice the shapes are a bit unusual. It'd be a whole lot easier to build a big square or a big rectangle. The problem with that is what you end up having is very long hallways. So if you imagine a home, most homes don't have really long hallways. So what we've done is we've eliminated the long hallways by our design feature. And so what that means is when you walk in, you've got a nice entrance, you've got clusters of rooms, so it doesn't feel like you're in an institution. Because if you're in a hallway, and I kid you not, I've been in an assisted living facility that had at least 120 or 150 yard hallway. It's very disorienting. You don't feel like you're at home. You don't feel like you're in a place that's loving and warm. You feel like you're in a hospital or an institutional setting. So the three big things we've done is, to recap, change where the parking is going to be so that the houses face out and the backyards face each other. We've added the sales and admin building, and we've also solved the long hallway problem that you would get if you were just trying to build these for the cheapest cost possible. If you want some names of some facilities, Mustang Creek in Dallas, Mayberry Gardens in Dallas are a couple you can research. Again, they're very different in terms of how they're designed, but they are basically planned residential care home communities. So I hope that answers your question, Doris.
All right.
Yes, thank you.
Perfect.
I was very curious looking at the design and wondering about your logic of that. So thank you.
Steve. All right. Eric is asking, what is the plan at year 10? Is the plan to sell, or is the plan to continue to operate?
So the plan is to sell. The plan is to sell at year 10. The reason why we're doing that is because now we've made it through. Now I should probably get a medal for this, and I know I can't see you laughing, but we've made it through an entire senior housing call for 1 hour and 5 minutes, and I have not said the phrase baby boomer, not once. So I deserve a medal for that, because everybody in assisted living talks about baby boomers all day. Now, what I will tell you is the oldest baby boomer right now is about 71, 72 years old. They were born in 1946.
The ER is ready to go.
So, Victor, if you just mute that other person.
Okay. Yep.
So the oldest baby boomer is not at this time is 71, 72 years old. The reason why that matters is because what's going to happen is these demographic shifts start to take place. The average person in assisted living is about 85 years old. So when people start to get to be 79, 80, 81, that's when they really start interacting with assisted living and memory care on a massive scale. So our anticipation is that just like you saw in single family homes where you had these hedge funds, these pools of money come into single family homes and buy up huge amounts of inventory, we think you're going to see that in senior housing, and that the start of the peak of that is going to be in about 8 to 10 years. So that's why we've modeled to sell in 10 years, is because we anticipate at some point our phone's going to ring and we're going to answer it, and it's going to be some hedge fund under the phone saying, hey, we'd like to buy your 1,000 beds you have spread over this region. and we'd like to buy them from you at a 6% cap rate or 6.5% cap rate. So that's a big part of the exit strategy. So this is one of the few deals where the exit strategy is to answer the phone. What I will tell you is that in senior housing, operators are very rare. So one of the reasons why I set out to become a senior housing operator, not just an owner, is because I think it allows us to really steer the ship correctly, and we can take this project and subsequent other projects into the proper channels and ensure that the exit is successful. Eric, did that answer your question?
Yeah, just a quick follow-up.
Good.
How does the investor participate in the sale?
So the sale would be split at 67% for the investor and 33% for the sponsor. So the numbers you see in the business plan, so 67% of the money will go to the investors, 33% will go to the sponsor at that time. Now that's based on the premise.
So let me clarify that a little further, Lo. So the way that we've modeled that is we assumed a transaction cost for the sale, which includes both, realtor fees and, title insurance and land transfer tax and all that stuff at 10%. So we're saying 90% of the net proceeds would flow through. Then the senior debt gets repaid, and then the residue from the sale gets split 67%, 33% between the investors and the sponsors.
Yes. Thank you, Victor.
And finally, was that built into the IRR?
Yes.
Yes, sir.
Yes. Okay. Thank you.
Now, I will say there's one thing that there's two things we don't have in the business plan. So you'll notice the business plan has nothing to do with phase 3. So all the financial modeling assumes that only phase 2 happens. Right. So if phase 3 were to happen, you would have the infusion of the capital that when the land gets sold. You'd also have the reduction in the shared expenses, which would increase the NOI. The increasing of the net operating income will obviously increase cash flow on a monthly basis. But also, if you increase cash flow and you increase NOI, you also raise the value of the whole project. So there are opportunities to outperform this business plan, something to be aware of. And then Kevin had a question as well. Is a construction loan floating on rate at Wall Street Journal? That is correct. The construction loan is at prime plus nothing. So it's just floating at prime Wall Street Journal rate. Well, I don't see any additional questions, and I think we're just a few minutes over. So if I maybe have time for one more question, and if not, I want to tell everyone thank you for joining the call. We actually peaked at 29 participants, which, given the fact that we announced this a day ago, I'm pretty pleased and appreciate everybody participating and asking questions. And on behalf of the team, I want to thank everybody for your consideration. For those of you that are thinking about investing, again, you have everybody's contact information. Please let us know if we can help in any way. So any last questions to sneak in?
So we are accepting commitments at this point. So if you are interested and would like to reserve a spot, please reach out either to Dave at therealassetinvestor.com or to Lo, and his email address is Lo at the Sage Oak?
Lo at the
sageoak.com.
And remember, we gave you that contact information. We'll give a copy of the recording. So if you're on the call because you know someone on the team, obviously, so you can interface with that person, or if you have questions for other members of the team, feel free to do that. Victor, is there anything else you want to add?
No, I think that's it.
Dave, anything you want to add at the end here?
I think we're good. I am available tomorrow, and I'm expecting to be talking to quite a few of the guys on the call. So I'm looking forward to that. I've got the first half of my day sort of open just for that. So I'm looking forward to talking to you guys.
And the beautiful and Cajun Pamela, anything you'd like to add?
Oh, I just want to add that anybody that is interested, we welcome you. And Lo, by the way, you did an awesome job. It was very thorough and gave us very comprehensive information. So I hope that we have quite a few of you all to join us. Come on down and visit.
Perfect. Okay. Well, I guess the only other thing to add is the funds are due by October 22nd. So it is a little bit fast on that perspective. We anticipate having legal documents done during the week of October 8th. So sometime during that week, we'll have the private placement memorandum, operating agreements, things like that. So if you have any questions, please let us know. But the legal team is already hard at work on getting these documents turned out. And we look forward to working with all of you and to chatting with you about future projects as well. Thank you, everybody.